So, hi everyone. We have Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence, to provide insight into the Fed's rate plans and its market implications. Hi, Mike.
Hi, Kyla. Thanks for having me back.
Of course, yeah. So, we have fresh inflation data coming this week with an update to the Consumer Price Index set for Wednesday, April 10th. What are your expectations for this release?
Yes. So our economist Kim Wong expects 0.3% on the month over month. The core, which is the one that really matters, core CPI is expected to come at 3.7%, which we know is about almost double the Fed's target. And obviously the risk is the numbers are a little bit higher than expected. But what's been notable is since we've had this big uptick in stock market prices and crypto prices and things, and even crude oil and stuff, we've had upticks in inflation. I think that's somewhat indicative that every single time these intangible, most assets go up, we're taking away the potential for Fed to ease, which means I think, to put a thought on it, I don't think there's really a chance for the Fed to ease until the stock market tells them to, because it's creating inflation. There is inflation. There's massive speculative excesses. And what's the hurry? Why take the risk?
Yeah. And so the Fed does have a meeting on April 30th where they're
Yeah.
going to decide on the next interest rate move. So you don't expect the Fed to cut rates at the end of April.
No, the next meetings we have May 1st, June 12th, and then July 31st is what I see for meetings. And May 1st is already, there's not priced in the system. So I'm looking at futures. Futures are priced about a 50 chance they'll cut in June, and closer to 90% they'll cut by July. And I don't think that's going to happen until the stock market tells them to, because why? Why take that risk? And this is what Chairman Powell said all along. And that means that probably take a little drawdown in the equity market, which we're way overdue for. But for now, why mess up something that's not broke? I mean, we already seen somewhat disinflation, like with this number seen in core. It's in a 3 handle, 3.7. I think the peak was 8 or 9. PPI was much higher, it's around 20%. And for a while, so we're still seeing disinflation. But the bottom line is, Fed, I think, is out of the picture to ease, and that's key. The trend this year. We've been taking all these eases out of the system until you see, I think, some deflation in the equity market.
Mm-hmm. And so for you, when are you seeing the market price in that rate cut in 2024?
Well, it depends. I mean, right now we're looking at, we might get, what I keep looking at is, I always look forward for 1 year. 1 year forward futures are priced for about 100 basis points of cuts. At the beginning of this year, for 1 year forward, the full 12 months ahead, there's priced for about 160, 170 basis points of cuts. We've taken those out. But I'll give you an indication of how well that hasn't worked for a while. Is the market first started pricing in futures market for 100 basis points of cuts at the beginning of 2023, and the Fed hiked another 100 basis points. So I think we're still in the hangover from that. We still have a decent, the thing that's unique right now is just a massive amount of fiscal spending that's keeping things buoyant. We still have a decent amount of wealth effect, and inflation's above targets. And in that environment, it's just silly that we're still pricing for all this easing. But I think that's what human nature does. Markets have forgotten about the risks of easing too much, which we went through. We found out we used too much and created all this inflation. And I think for the rest of most of our futures, our history, we're going to be reluctant to ease until we have significant signs of deflation. And right now it's disinflation, but you have deflation in commodities.
Mhm. And of course, consumers are spending on things like Bitcoin. So it's a sign that financial conditions might not be as tight as they are. So what is the path that you see for these riskier assets, such as Bitcoin and other cryptocurrencies, considering the Fed stance and just the general consumer euphoria that's going on right now?
Well, the key focus for me, is the rock is beating stocks. I mean, I'm very disconcerted that the gold is outperforming the stock market this year. Gold's up about 10%, actually 13% this year. S&P 500 total returns around 10%. And if you look at gold since the end of 2021, it's doubling the total return. The S&P 500 total returns about 13% there. Since then, gold's about 26%. Why is that important? Because the world changed in 2022. We have the war, the unlimited friendship between President Vladimir Putin and Z, and the significant tightening. So the way I see it now is I'm concerned that gold's beating everything. And then the way I like to describe gold is you really can't hold gold anymore without some Bitcoin in that space, unless you're willing to take the risk of the world going backwards and not going towards a digital value version of the metal. And that's what Bitcoin's doing. The significance is what's been notable is we've had significant ETF outflows in gold and inflows in Bitcoin ETFs, which is put some numbers on it. This year so far, a record-setting new ETF launches. The inflows have been around 12 to 13 billion into Bitcoin, and there's been about 7 billion out of gold. Yet gold's still making new highs. Why? Because some of the most deepest pockets on the planet, central banks are buying. So I'm still bullish gold, but the key concern I have, Kyla, is when we have a normal backup in beta, and that's the signals right now. I'm getting signals that the S&P 500 is very stretched. It just reached about 25% above its 100-week moving average. It's showing some signals of getting speculatively excessive, and it just needs a little back and chill. The last 10% correction set the bottom, and we're just overdue for something like that. So I'm kind of seeing how we get past that. And the key thing I like to point out is Bitcoin has a beta to gold and the stock market and S&P 500, but it's about 3 times the volatility. So when we do have a little bit of beta backup, which we're overdue for, I want to see how it performs. And typically it should go down about 2 to 3 times the percentage that the stock market does. Now, gold, I think, is on a much sounder footings. I mean, just breaking out of a 4-year range.
And can you talk a little bit more about why gold is moving the way that it is? Are people freaking out? Like, what's happening?
Bottom line fundamentally is the unlimited friendship between President Xi and President Putin established a floor for gold. And then we had the Russians' invasion of Ukraine, significant amount of de-dollarization that's happening from maybe what you would call the axis of antagonists, which was really established by China, by this unlimited friendship. And we have an unstoppable increase in U.S. debt to GDP. So those are very good, just more buyers, because typically what's happening from central banks is significant for gold. And what I see as the next iteration is basically, I think it's just a matter of time that gold gets to $3,000 an ounce. I've been saying that for a while. And 2000 is now key support. 2000 was that pivotal resistance, now converted to support. But the thing that I think is going to really flip for gold to really accelerate is when these gold ETF outflows, which have been significant, like I mentioned so far, just 7 billion in this year alone, which has only been about 3 months. That'll flip at some point to inflows. And I think it's going to take the competition to fall by the wayside. What's the key competition to gold? The unstoppable U.S. stock market and 5% U.S. Treasury rates. The key thing I like to mention is volatility, the VIX volatility index, the 52-week moving average of that index minus the T-bill rate is the lowest since 2007, right before the financial crisis. So very low stock market volatility, usually volatility always mean reverts higher, could be a catalyst for gold to accelerate the rally. And right now it's what, 2,300?
Mhm. And finally, Jamie Dimon, the CEO of JP Morgan, came out in the annual shareholder letter and said that he actually expects interest rates to go up to 8% because of these global tensions that you're talking about, because of high government spending. So do you agree with these insights? Do you think we could actually see the Fed hike again?
No. In fact, I'm the complete opposite. Let's first point out U.S. Treasury 10-year yield is about 4.4% or so. Let's compare that to Canada, to Europe, to China. They're all 3 or 2 handles. China's 10-year yield is 2%. Germany is in 2% handle. Greece is 100% basis points lower than the U.S. So put on a global scale, a global basis, the rest of the world's bond markets are showing a tilt towards deflationary recessions. And the U.S. remains a shining star. So not only that, our rates are too high, I think, in the U.S. It's just a matter of time they trickle down if and when the stock market has a little correction. We still have an inverted yield curve. Remember, those things used to matter. So I enjoyed Kyla writing a little while ago about stuff that used to matter. Now that the pendulum in this country is completely swung towards no recession and no landing or soft landing, just a little bit of tilt backwards that way, I think, is what's going to happen. And that's going to be pressure factor for bond yields, copper prices, crude oil prices, and a decent supportive factor for gold. So to me, that's the tilt. And the bottom line is the rest of the world's bond markets are tilting towards that recession. Or why is the yield on the 10-year note in China 2%, in Germany 2%, in Canada 3%, and in Greece 3%? And the US is in a 4% handle. That to me is the risk as we tilt that way. Now, if they were to hike rates, that would be inflationary. And that's very, on the back of inflation. In commodities, I see pretty mostly deflation, certainly from those 2022 peaks.
Mhm. Amazing. Well, thank you so much, Mike. This has been an incredible conversation.
Thanks for having me.